Hi guys, today I'm going to be teaching you how to actually trade in as short time as possible. My name's Pound, I've been trading since I was 15 years old, so for the last 6 years now, I've been consistently profitable. I'm going to show you my setup, everything that goes into it, and keep it as simple as possible, okay? So, no nonsense, just the best setup possible, okay? So what we're going to cover today is the reality of trading, okay? So, is this actually for you? Is this something that you want? Basics of a chart, basically just the only stuff that you actually need, the only stuff you need to know. I'm not going to try and add extra stuff that you don't need to know. It's only going to show you the necessary stuff, okay? So you probably see some 9-hour boot camp or whatnot. You don't need 9 hours, okay? I'm going to show you only what you need. How to actually manage your risk. Then I'm going to show you the setup. Then step by step how we're going to get you from not trading to profitability, okay? And then I'm going to show you how to journal. For me to teach you, I need you to delete everything you know currently. Okay, you've probably been if you haven't traded at all or seen anything online in this first video, perfect. Okay, that's even better. If you've been around and you've seen rubbish charts like this, you've seen fair value gaps, you've seen this fella and this fella teaching you absolute nonsense. Okay, you've sit for a 9-hour course and you've just learned nothing because they're just throwing loads of words at you, dribbled at you, loads of stuff that you're never going to understand, never use, and doesn't even work to begin with. Okay. These guys make a lot of money from courses, etc. So just please try and delete as much as you can from your brain if you have learned anything from these guys. Okay, I really do need to stress that it will mess you up. So the realities of trading. Okay, so do you want to be a trader? 99% of trading is doing literally nothing. Okay, we are just watching a chart come to our levels. Okay, so we need to understand that it's not as exciting. You're not doing. Obviously, there's different ways to trade. You can do high frequency trading, blah blah blah. But typically for most retail traders, especially when you have a job, whatnot, you ain't going to be doing this type of stuff. It's just going to be a lot of waiting. 99% of the time, you're just waiting. Okay, and observing. Okay. You can make a lot of money trading. This is through compounding. You just compound your wins, but understand that your bankroll is your life. Okay, so if you do want to be a full-time trader, buying glamorous or fancy things is not as simple as that. Okay, your bankroll is your life. You must protect your bankroll. Okay, so what do I mean by that? If you make 400 grand and you're trying to buy a 100 grand car, all of a sudden after obviously you got taxes and whatnot, but you're taking 100 grand from that. That's now 25% less profit you're going to make on your trades. That affects your compounding. Okay, so just understand that it's not like having a salary. When your salary comes in, you can spend that each month. Your bankroll is your life. Okay, the money you make affects your future money you will make. Okay, if you actually want to pursue trading, okay, and I advise you all to, everyone should give it a fair shot. Really dedicate yourself if this is something that interests you. Obviously, don't do it for the money. Do it because you like trading. You like the act of placing educated bets and being right. Just understand there are potentially easier ways to make money, but if you enjoy trading and you really like it, and this is what you want to do, keep your job. Okay, please don't ever quit your job and go full time into trading until you have got enough to sustain your living costs. Okay, why? Because trading to eat and trading to pay rent is very different to trading on the side. Okay, and trading when you can. Okay, because otherwise you'll be forcing trades. You'll be doing stupid stuff. Okay, so make sure this is not necessarily a full backup. This could be your main thing, but make sure you have some sort of income so that your living costs are not a problem. So we're going to start super basic. Okay, so what are candlesticks? Okay, candlesticks at the most basic level reflect buying and selling on the chart. Okay, so that's all trading. All trading is. Okay, all the chart is just a reflection of buying and selling put these data points onto a chart, and that's what it shows. Okay, so you can use line graphs like the charts that look like this. Okay, that is another way, but typically it doesn't give you as much information as candlesticks. Okay, this is a bullish candlestick, so price opened lower than it closed. Okay, so what do we mean by close? Okay, so after an hour, let's say 5 minutes, we'll use 5 minutes. So every 5 minutes, the candle is closed, which means that the price changes and then reflected in that, if that makes sense. Okay, so maybe at 12 o'clock, the price opened here. At 12:05, the price was here, so it closed here. Okay, but what can happen during this 5 minutes if we look on the 1 minute chart? So if we zoom in and during this 5 minute price action, what can happen is price can go from maybe opens here, price can go all the way up here, and then close down here. Okay, so what do we see? Here it's opened here, closed here, but it actually did go this high. Okay, so this is what this wick bit represents. Okay, so it's basically the highest point which price reached, vice versa on the lowest. Okie dokie, I hope that makes sense. So again, yeah, it basically indicates what price was doing during that period of time. Okay, so you can have like an hourly candle, and within the hourly candle you can have 12 5-minute candles. Okay, just for example. So yeah, that's basically it. That's basically it. All it is to candles. But what can it represent? What information can we gather it from? If we see a long wick, for example, like this candle here, we can see that there's obviously someone has stepped in. Okay, so this was all the way down. Someone selling this came all the way down here, and then someone bought it all up. Okay, so price candlesticks are better at showing like the emotion on the chart is the best way I can describe it than just a line. Okay, with a line you don't have this information that you can gather. Okay, so with this massive wick, this indicates that someone stepped in, someone's bought a load here to bring price back up to the bullish candle. Okay, so you get a little bit more information, which will make a lot more sense in a bit, but you get more information from a candlestick than you do other parts. One other thing, this is called the body. Okay, so when I'm saying draw levels from the body, this is what I mean. Okay, this bit here, so this would be the body, this would be the body, this would be the body. Okay, this is the wick up here. Okay, so from the body is the fat bit. So a few little keywords. Okay, so a long position essentially means that you're betting on the market to go up. A short position means you're betting on the market to go down. Now, one of these is more favourable than the other and has a higher return rate. What I mean by that is, if you're longing something, your gains are infinite. Okay, so you could buy an apple for $1. That apple can go up to infinity dollars if it wants to. Okay, if you're shorting apples, which means you're betting the price to go down, you basically borrow apples from someone else and then repay them late. Sell them on the spot and then repay them later. That apple can only go to 0, okay? It can't go to lower than 0. So your gains are capped at 100%. Okay, I hope that makes sense a little. What do we mean by a retest? Okay, so this is when price returns to a previously significant level to test it. Okay, so I'm just going to draw a little line, for example. So I'll show you a bit of example, some examples of this. So if this is our level, price comes up and tests the level. Okay, so price can maybe even smash down, fail. Price could go above. Okay, this is what I mean by retest. Okay, so it's just going to come to the level and do business at the level. Fills is when we fill an order. Okay, and this will come into more detail in a bit when we talk about what the bigger players are doing and the setup. Fills, when I say fills, just basically means where people can get their orders actually filled. Okay, because the game is zero sum. What do we mean by zero sum? For me to buy, someone else has to sell. I have to fill their sell. If I want to buy, place a buy order, someone has to sell into my buy order. Okay, vice versa. So that's what I mean by fill. Someone has to fill the orders. Invalidation is a price. Often we use a stop loss for invalidation, but basically where you're wrong. Okay, so when you go into a trade, you need to have an idea of like where I'm wrong. This is going against me. I'm wrong. Otherwise, you're just gambling. Okay, so we need to know. Okay, this is where I'm wrong. Price is reversed here. I'm wrong. I'll take the L. We'll look to get back in. Okay, reclaim. Okay, so when I say the word reclaim, it means that a level that was previously significant. So I don't know, like we use the word support and resistance, but they aren't really a thing. We'll get into that later, but we'll use the word support for now, if you've heard that phrase. Reclaim, example of this would be price comes up, breaks through the level, retests, and then goes up higher. Okay, example of a failed reclaim would be here, price comes up and then smashes back down and goes through the level again. Okay, so if that makes sense. So this held the level, so that would be a reclaim. This level has been reclaimed. This level failed to reclaim as it went through, boom, failed down. Okay, this will be all relevant information in a little bit when we actually get to the setup. So we need to understand our stop loss and take profit. Okay, so these are the two things that are actually going to allow us to keep ourselves safe and also take our profits. So what is risk to reward first and foremost? This is the number one thing for our risk management. Okay, we're essentially, if we risk $1, we're correct, we make $4. Okay, I would not advise taking anything less than 4 to 1. Reason being, especially to begin with, you can a little bit later down the line, but to begin with, nothing less than 4 to 1. Why? Because we only have to be right 25% of the time to make money. Okay, if we can literally lose 3 out of 4 trades and still make money. Okay, this is what we want to be doing. A stop loss essentially just basically takes us out of the trade when the price gets to a certain point. Why is this useful? Because obviously we don't need to monitor the trade to actively click out, and also it just allows us to be basically set our risk. Okay, so we're wrong at this point, our invalidation. So I want you to remember this in a little bit, that when your stop loss gets hit, if you're longing, you're forced to sell. If your stop loss gets hit when you're shorting, you're forced to buy back. Okay, that'll be very relevant in a little bit, so please remember that. So yeah, that's the basics to stop losses and take profits. Super simple. A little bit more to it, which we'll go over later with actual stop placement, how to use our stops effectively. But just understand that with our stop loss, we want to be as wrong as soon as possible for as little loss as possible. Okay, so we don't want to be held with massively wide stop losses that decreases our risk to reward ratio, because chances are if we're wrong here, we're probably going to be wrong down here. Okay, well, I'll go into depth in a little bit, but you want to keep your stop losses as tight as possible in smart places. Okay, we don't want to be having a stop loss that's super tight for no reason, but we also don't want to have a stop loss that's way too wide, decreasing our risk to reward ratio. And likelihood is, if we get stopped here, we would also get stopped down here. Okay, if price turns against us, we'd get stopped here, but we'd also get stopped here. The risk to reward would be massively different. We'll get into that a little bit later. Okay, so now we're going on to understanding price action. Okay, so understand nothing has to happen. Okay, nothing ever has to happen. Price doesn't have to get to a level. Price doesn't have to get to a trend line and bounce. Price doesn't have to do anything. It's simply a reflection of buys and sells. What do I mean by this? If Trump tomorrow comes out and says that zinc will be now used as a Federal Reserve, where every dollar has to be backed by zinc, what do you think happens to the price of zinc? It goes to the moon. Okay, that is not coming down for a very, very long time. Okay, even if it's heading into resistance, that is not, no one's selling their zinc into resistance. Okay, so you can do all the technical analysis in the world, but when it comes to that resistance in quotes unquote is not holding. Okay, because why? Because people just want to buy, and it goes the other way around. When shit hits the fan, people just want to sell. Okay, for example, COVID, people just want to sell when they want to sell. People want to buy when they want to buy. Okay, so nothing has to happen. But what can happen is, at these levels, we want to be observing. Okay, because things can happen, and the market can show its hand, and we want to be riding the waves when the market does show its hand. A common mistake is people attribute stuff to the wrong things. Okay, so what do I mean by that? I'm assuming you have a little bit of knowledge here, but if you've seen a chart and you've seen a trend line, okay, and you've seen this is price, boom, bounce off the trend line, and then breaks the trend line all of a sudden, this is rubbish. Okay, why? Because this is not actually what's happening. Okay, at a deeper level of the markets, where bigger players are making decisions, they're not making decisions off trend lines. Okay, they're looking at areas of liquidity and where people's stop losses are placed. Okay, this is all basically male astrology. I don't say male because females trade as well, but trading astrology. Okay, this is all like hocus pocus. I'm going to draw a line there. Sometimes it might work, sometimes it may work. Same with support resistance. Okay, people have support. These are all psychological levels, meaning that the only reason support will hold is because other people buy on the assumption that other people are going to buy. The game's also a zero-sum game. Okay, so understand that. I mentioned a little bit earlier with the fills, where for me to make a profit, someone else has to make a loss. Okay, so just please understand that when trading, it's very PvP. You come into the game with your money, and you're trying to leave with someone else's money. So it's just have that in the back of your head. It's a PvP. Not everyone gets to make money. You have to be smarter than the rest. So at the basis of the trading strategy setup is trading where it matters. Okay, so there's a lot of noise in trading. Okay, and we need to be only trading at key points where people who actually matter in the market are making the decisions. Okay, so what do I mean by this? If you're a big player, I want you to imagine you're worth hundreds of millions. Okay, you have to make the decision. You buy and sell. As we mentioned earlier, it's a zero-sum game, meaning that if I want to sell, I have to get a load of buyers. Okay, I want to sell $100 million. I have to get people to buy $100 million of my stock. If I do buy at this point, I'm going to get a massive market impact. Okay, so market impact refers to when your price spreads. Okay, we'll go into that a little bit later, but essentially it's if I don't have enough orders, if there aren't enough orders to fill, price will find the next highest order, which will continue up until it fills all the orders. Okay, so there's no guarantee how high that is, and oftentimes you see big wicks where price is basically just trying to find the next order, and you get spreads. Okay, so maybe I wanted to buy at $100, I might get fills at $105, which obviously you can imagine 5% on 100 million is a lot of money. Okay, and this is what the big players don't want to do. They want to be getting at the price and actually getting in and out of the market with the size they want to get, size into. I'll say that again. They want to get into the market with the size that they want at the place they want. Okay, so as we mentioned earlier, stop losses are forced position closes. Okay, so when stop losses get hit, you're forced to do the opposite of what it is. So if I'm long in, I'm forced to sell. If I'm short in, I'm forced to buy back. So big players know this, and they know that they wait to make decisions around places where stop losses are resting. Why? Because they know there's going to be a lot of forced selling or a lot of forced buying, so they can fill their orders at these points. Okay. So how do we know where these levels are? These are typically the last thing that sent price up and the last thing that sent price down. Okay. So as you can see on the chart, this is the last thing from current price that sent price down, and this is the last thing that sent price up. Okay, the lowest thing that sent price up. Okay, so this is oftentimes if people who are long here, long here, long here, long here have their stops resting around this point. Same thing if they're short here, likely have their stops around this point. Okay, so they know that when price gets to here, you're going to get a lot of forced selling. Okay, so and that's oftentimes where you see, not necessarily here, but big wicks, because guys. That's guys getting stops getting hit. Okay, so guys, if stops get hit here, price comes up here, they're forced to buy back. Okay, and that's where you get big wicks. Okay, I hope that's clear. I know I've just drawn a load of dots on the screen. So we're only watching and observing at key points. That's the basis of this. Okay, we only want to see where business is being done by big players who dictate where the market is going. We want to see that when price gets to our level, it's being defended. Okay, so I'm just going to drop the size of this pen down a little bit because it's a bit too big for me. Okie dokie. Right. So DDT, this is the setup, done the thing. The basis of it is we're looking at the key important points where stop losses are resting. We're looking for big players to get in and save the market. Okay, so people bigger than myself, people bigger than you, to jump in, say I'm going to defend this level. This level price is not going to go down this level, below this level. That gives us a free ride to the place where they're going to offload that level. Okay, so we need to understand that if someone wants to buy 100 million, okay, massive size at a certain level, they also need to offload this. Okay, so they also have the same problem on the way out. On the same way in, they need a load of selling. On the same way out, if they want to sell at the price they want to sell, they need a load of buying. Okay, so you want to be selling at the places where the most buying is happening and buying at the place where the most selling is happening. Okay, so with this logic, this is how the birth of DDT came into. Okay, so it uses just simple two things, no mad indicators, just volume and price action. Okay, so just the actual chart. So the basis of DDT is price goes down. Okay, so as we can see, price continues down. It stops going down. Okay, so price has stopped going down here. It continues up. So at this moment, we're doing nothing. We're just observing. We've marked out our level. This is where price continued down. Price stops going down, obviously here. We start to see selling wane. Okay, so we start to see that the selling started to decrease. Okay, so price continues up, but we're still not taking an entry. We're not FOMOing in. We're just observing. Okay, price continues up, starting to see less selling. Okay, a bit more buying stepping in. We now see that price loses the level. Okay, so price lost the level here. Okay, closed below. Price then closed above. Okay, so we're now looking for this to regain. Okay, so for it to regain, we need a retest. We saw that then price retested the level and failed. Okay, so we're not getting in. We're not touching this at the moment. We're not in any trade. We've just observed. Okay, price has gained it, retested it, and closed the blow. Okay, so no trade has been taken. Nothing, no money is lost. We're just observing. Okay, this illustrates how much we want to observe. Had we gone long here, we would have been stopped out here. So, where are we? So, prices continued down, stopped going down. Prices continued up. We've lost the level that we previously held. Someone stepped in to save it. Price failed on the retest. Okay, so no one stepped in enough. Price continues up, closed above the level. So we still haven't reclaimed it. We're just waiting for a retest. We got the retest and price closed above. Okay, so this would be our time to go long. Okay, so you can't really see it on this picture, but basically the wick was here. This is the wick. So price was going down, stopped going down. Price lost the level, regained the level, retested the level. So we reclaimed the level, and now we're going long to the first thing that sent price down. Okay, so if you remember beforehand, we had the problem where these guys need lots of stop losses to fill their orders. Okay, now they need the same thing. They need the stop losses to exit their orders, and the stop losses are resting at places where there's a lot of short stop losses. Okay, so here, this would be our first TP. So I remember I said before, always 4 to 1. As we can see, stop within the wick, as we can see here, stop is placed within the structure above the local low that regained the level. So this is within the structure, this regained the level. And then we target the last thing that sent price down. Okay, so this would be a 4 to 1 trade. We would take this trade. As you can see, price here, we close 40%. Now we move stops to break even, and then we target the next significant thing to send price down. So we could target here, but this isn't a significant. This is more significant. Okay, price hit it. After the first thing is hit, people can exit their positions. Okay, so there's no guarantee. That's why we move stops to break even, close 40%. The next significant thing, close another 40%, and then we leave 20% running. Okay, because as you can see, price continued up. We don't know what's going to happen. We leave 20% just in case we get a runner. It continues up much higher. We've still got a position on side. Okay, so I'm going to do a little recap now. I hope that was clear. I know it probably sounds a lot, but I do hope that was clear. The basis of this is a lot of observing. Okay, we're always observing. We're just watching price happen. When we see someone step into the market and want to defend a level, we get involved. Okay, so again, price goes down, stops going down, we mark out our level. We're also watching the volume, which, by the way, if you want to get the volume indicator, it's all in my Discord. Okay, completely for free. Which you're either watching this through the Discord. If you go to the setups channel, it'll all be there. So we see that price continues down, selling starts to decrease. Okay, so we're getting some buying increasing. Yep, selling starting to decrease below the average. We then lose the level, we gain the level. Okay, we retest the level and it fails to hold. Okay, but then we gain it again. Okay, so we close above. We then retest the level and it holds this time. Okay, so that's our sign to go long. Okay, we also see that buying volumes on the increase, but we hold the level. We go long, targeting the first thing that sent price down. Okay, boom, hits it, close 40%. Next significant thing to send price down, close another 40%, let 20% run. That's now discretionary. Okay, I hope that makes sense. Don't worry, in a little bit we've got some live trades. So I've got a video of me doing some live stuff, talking about time frames and all of this actually in practice, some more examples for you guys. So yeah, so how does this actually look? Okay, so when we're just marking our levels, we basically want to mark the last thing that sent price down and last things that sent price up. Okay, significant things that sent price up. So I want to do a little quiz. I'm going to leave it on screen. What is the last thing that sent price down? Okay, A, B, or C? Okay, so what from your mind, from what you've gathered now, what do you think is the last thing and it's got the correct line? Okay, so the answer is A. This is the last thing that sent price down. Okay, so price is here. This was the last thing that sent price down. Okay, so just get that in your mind when marking out levels. Okay, before we move on, I just want to show you some of the setups that I sent live. Okay, so this is an example of perfect, super clean example of DDT that we shared live in the chat. What do you notice? Price stops going down. Price loses the level, regains the level, retests the level, closes, and then we go long. Okay, we're targeting the last thing that sent price down. As you can see, price hit it. Okay, so that's a bang on example of exactly what's happening at DDT. Okay, so I hope you can see that. So I'll show you one more time. Price continues down, stops going down, loses the level, regains the level, and then closes below. Okay, so this was actually, I believe if I remember correctly, it was on the 15-minute chart. Okay, so this trade setup can be taken on all time frames. Okay, I don't recommend having levels lower than 15 minutes because it's typically less significant. So what do you mean by time frame? Okay, so when I say time frame, it's obviously daily, 4 hour, 1 hour, weekly. The higher the time frame, the more significant the level. Okay, why is this? Because more people are going to be looking at it. If you're a bigger player, how many guys who sit on 100 million are sitting there on the 5-minute chart? Not too many. Okay, so yeah, so we want to understand that the higher the time frame, the more significant the level. So that's why we use typically 1 to 2 levels below, time frames below our current level. Okay, so what do I mean by that? If this is our low here, boom, and this is the last thing that sent price down. Okay, so let's imagine we're here. Okay, actually, I'm going to just slap the replay on it. Yeah. Boom. Okie dokie. Oh. Okay, so that's where price stopped going down. So price continued down, stopped going down. Okay, so we've got this price action here. Now we've got our 4-hour level where last thing that sent price down. I hope you can see that. That's where a lot of stops are going to be resting. This is where a lot of stops are going to be resting. Okay. Boom. Okay. Last thing that sent that price down. You can do the short side, but we're just going to focus on the long side today. So that could potentially be a short there. But for now, we're going to look at the long side. We're waiting for the retest of this level. Boom. Okie dokie. Let's have a look at this, how this looks on the 4-hour. So I've just glazed over a bit of price action. This is days. Okay. But you can do this on any time frame. But I'm just going to use the daily because it typically is a bit more cleaner. Okay, so what does actually a trade look like now? So we're going to use the 4-hour level. Why? Because it's quite a big range. We're going to use the 4-hour or the 1-hour range. Okay, you can go down to the 30 or the 15-minute. I'd only recommend going 3 to 2 lower. Sorry, if we're using a daily level, 1 lower would be 4-hour, 2 lower would be the hourly, 3 lower would be the 30-minute. Okay, so I'd only recommend going super low, much lower, if we're trading a really tight range. Why? Because we have less time to get in. Okay, so if price is doing this, where it's between a very compact range, or here, for example, very compact range, you have less time to get in, so you need to go a little bit lower time frame. Okay, but as we've got a decent sized range, we can go 4 hour, 1 hour, 2 below. We're going to use the 1 hour for now. Okay, so the daily level looks a little bit different now on the daily. The daily level looks a little bit different on the 1 hour and the 4 hour. Okay, it looks a bit messy. Looks like it's been placed in the middle of nowhere. Okay, so we always use multiple time frames to observe how this looks. So obviously this is replay, so we can obviously see what happens. But I'm just going to show you how an entry would look. So tested the level. This is our level on the daily. We're using the hourly to get a better idea. We lost the level, we gained the level, and then we went for the retest. Okay, so this was our retest. It retested the level and held it. Boom. So this is when we start looking to get long. So on the close, perfecto, within the wick. Okay, so we want to have our stop within the wick. Okay, so not down here, underneath the wick, because the likelihood is if price hits here, it's also going to hit here and also hit here. Okay, we want to be wrong as soon as possible. Okay, so if price stops doing what it should, where price should held the level, someone's defended the level, price should continue up. Okay, so that's what it should be doing. If price stops doing that and continues down, we want to be out of there. We want to, like, nope, this is not doing what I think it should be. I want out of here. Boom, price within the wick, targeting the last thing that sent price down. Okay, we want to target just above it. Why? Because as we mentioned before, people, when these stops get hit, they're going to be forced out of their positions, and then you're going to see wicks like this. Okay, so that's where you get big wicks or big price move, because people are forced to buy back. And yeah, so we typically target just higher than the TP. So this looks like a good trade. Okay, so 4 RR just about. We'll take this trade all day. Okay, so this looks perfect. 4 RR to the last thing that sent price down. Okay, so on the lower time frame, this would be the last thing that sent price down. Okay, so we're out at 4 RR. If the first thing that sent price down is higher than 4 RR, we always take 40% at 4 RR anyway. Okay, and I'm saying 4 RR a lot, but we just take 40% at 4 RR flat. And if the last thing that sent price down isn't 4 RR away, we don't take the trade. Okay, and this is the discipline I'm talking about. We need to be very disciplined with our trading. So what would happen? We take 40% out. We would close 40% here. Okay, so we've still got 60% running. Now we'd move our stop loss to break even. Boom. Okay, so this is a risk-free trade. We've got 40% out. It's set and forget as well, by the way. So until you hit the first TP, we don't touch the trade. We don't move our stop to break even. We just let it run. Okay, if we get stopped out, we get stopped out. We go again. So first TP. Now we're looking for the next significant thing that sent price down. Okay, so that will be here. Okay, so we'd have our TP here. Okay, boom. What's that? Is it RR? Okay, obviously the stop's a bit messed up because of a thingy. But yeah, so as you can see, the RR's there. Boom. Close another 40%. Boom. And now we let 20% run. Okay, so we don't know what price is going to happen. So this is what we're waiting for. Boom. Boom. Okay, we get our TP. Okay, what happened with the volume? Okay, so as we can see, price went down, lost the level, regained the level, and we started to see some buying step in. Okay, and eventually we got more buying volume coming in, and that's why we got the big move. Okay, so pay attention to this. If we were starting to see selling increase into this level, so see how selling on the decrease, it goes big candle, then buying step in. Okay, see this buying's on the increase. Okay, that's how we know we're good. Okay, so if we were seeing, I don't know, like selling on the increase, that we don't know whether the level is going to hold. People are continuing to sell into level. We start to see selling to decrease, then buying stepping in. Okay, so price hasn't done any mad movements, just volume, buying volume stepping in, looking decent on the increase. Then we get the big move. Okay, so I hope that makes sense. And then we let 20% run, close where you want to close a little bit at a time, yada yada yada. So why is our stop loss so tight? I've mentioned it a little bit earlier. Our stop loss is super tight just because we want to be wrong as soon as possible. When price turns against us, let's say we have our level, boom, price is supposed to be going up. Okay, price is supposed to be going up. The biggest mistake people worry about is a wick. Okay, so they worry that they have their stop loss here. They're gonna have their let's take a trade here, boom. They have their stop loss all the way down here because they're worried that price will wick them. Okay, so they're gonna go whoa, and a wick and then continue up to what they're doing. We don't care about that. Why? Because we're observing the market. If price stops doing what it should, and then it goes and does what it should do, we're back in. Okay, so this is our trade. Boom, tight stop loss here. If price continues up, boom, we get into our trade, and then it goes against us, stops us out, and then goes again. We just go again. Okay, so we're back in. We're back into the trade here. We never fear a loss. Okay, the reason the trade is for RR is that we can be wrong literally 3 out of 4 times and still make money. So we never fear a loss. I'd rather be wrong super soon rather than have a wider stop loss because I'm a pussy, basically. Okay, so why proper stop placement is important. This is a little example. So if our stop losses are really wide because we're a pussy, and we were targeting up here, and our stop was here. Okay, so you can see the risk to reward ratio. Let's say it's 10 to 1. As soon as we move our stop down here, okay, and just because we're worried that we're going to get wicked out, we're worried that price is going to go, because, sorry, if that stop was here, worried that price is going to go what? Stop us and go, okay? We'd have our stop loss down here, okay? And that's really why, and look at what it does to our RR, okay? So 2.7 to 6, okay? And that's literally a 3 times RR, okay? So you need to be right 3 times more with a wide stop loss than you do the tight one, okay? Now, look what happened as soon as price returned to this level, okay? So price did what it should do, and as soon as it stopped doing what it did, it rammed through that level and hit stops all the way down here, okay? So had our stop loss been here, it would have been hit here, it would have been hit here, it would have been hit here, okay? So actually having that tighter stop loss allows us to increase our RR, and also we were wrong as soon as possible. We took a little loss as possible, basically. So what would have happened if price broke down and then continued up and then bounced? Boom, we would have got back on side. Okay, so maybe we would have got stopped here and not got stopped here, but we would have made a loss. Boom, back in again, and we get on side again. Okay, but majority of the time, if price stops doing what it should do, it's going to continue and hit all the stop losses. Okay, it's going to go against you, and we're going to get stopped out either way. We want to maximize our RR and be right as much as possible. Now, I don't mean bring your stop loss into stupid places like this to maximize your RR, okay? I mean, put it sensibly, okay? So make sure that your stop is in the right place and it makes sense. Don't just make a super tight for the sake of having a super tight stop. Make sure your stop is in the right place and correct. And if the RR is crazy, like sometimes it will be absolutely mental, then boom, perfect. But make sure your stop is in the correct place and or smartly placed, not just super tight for the sake of it, if it doesn't make sense. Okay, so I hope that makes sense. That's just a little bit on stop losses and the general setup. So I'm going to try and keep this video under an hour. If you're in the Discord, you join. I've actually got some videos of me doing it live, okay, so which I'll link in the description as well, and just more live stuff. So me talking through. I've already done these videos, so I don't need to do them again. So yeah, so you can see that if you're still a little bit confused or you want to see how it looks a bit more live, or me just talking through the trade and understanding more stuff about timeframes, I've got some videos on that. But this is the general basics, okay? So I've tried to keep this under an hour, short, as sweet as possible. I want you guys to go away and master this setup, okay? This is the only setup you need to make money. You don't need any confusing fair value gap stuff. I know this may seem a bit daunting at first, but I promise you it's super, super simple. Guys in the Discord have picked it up within literal hours, some of them. Maximum I've seen is like 2 or 3 days, okay? The reason is I'm here to help you guys. I've got so much time, and you've got so much time at my time, and you guys can just ask loads of questions, send your setups. If we get it wrong, we'll make the tweaks and we'll get it all right, okay? And we'll make you guys profitable. Now, what I want you to do is that if you're not in the Discord, join the Discord. It's completely free. I want you to complete the quiz. There's a little quiz in there, and I want you to post some charts where you notice DDT, okay? I just want you to just go scan through the chart and just point out some examples where you think DDT has occurred, okay? I'll come in and say, yep, that's correct, or no, or can you elaborate more, okay? Then I want you to interact with the chat, talk to the boys, and then go paper trade, okay? So I want you to either do replay trading or paper trading. Yes, so paper trading, basically just demo trading. Take it with an account and then take 100 trades, okay? But I want you to journal these trades. Now, why is journaling so important? The only thing, I've given you the setup works. The only thing that's going to screw this up is your emotions. Okay, if you keep making the same mistake over and over again, and if we don't iron this out, you're going to continue to lose money. So what I want to do is journal 100 trades. Now with your trade journaling, I want you to understand at the end of the trade, I want you to write down what went wrong, what did you do wrong. Sometimes, don't get me wrong, you're just going to get stopped out. That's unlucky, and then there's nothing you can do better. But if you took the trade for a wrong reason, like you FOMO'd in, like fear of missing out, you just got too early, the RR wasn't there, you were lazy, you were undisciplined. I want you to write that down, okay, and make note of that. What was the mistake that caused you to lose this trade? Sometimes there will be no mistake, just you took the good trade, you took everything right, and unfortunately market turned against you. Boom, no problem with that. But I want you to make the reason journaling is so important if you're not making the same mistakes. If I was there over your shoulder every day, I'd be able to point this out. You in your head might think, oh, I don't need to journal. I'll just remember it. I promise you, you won't. You'll keep making the same mistake, and you won't even know you're making the same mistake. So journaling is super important. You can create your own journal on like a spreadsheet, or I've actually got journaling software in the Discord. If you check the journal page, basically auto does it all for you, and also has demo trade, paper trading as closely related to exchange, so you guys can get as good experience as possible. Literally one-to-one with all the quality of life features. So yeah, I want to see you actually be profitable on paper trading. Journal 100 trades. Understand where you're going wrong. Ask all the questions, as many questions as you want in the Discord. And then when you're actually profitable on 100 trades, we go live, okay? If you're not profitable, we go back to the drawing board and see what went wrong, okay? And we need to address that. And obviously you'll have a whole journal to go through that and address those issues. So yeah, please go through the resources in the Discord as well. I'm going to post some linked videos in the bottom of me doing a bit more live, a bit more stuff on stop losses, a bit more stuff on timeframes, so you guys have better resources. And yeah, you can absolutely become profitable, and it's easier than you think when you have the right information and you have time to dedicate to this, and you have basically someone that knows what they're doing to correct you on your mistakes. Okay, you guys can really make some really good progress very quickly. And yeah, that's what I'm here for. Let's make some money, guys. So yeah, please check out the videos. Make sure you go through and watch all the videos below. Join the Discord, get stuck in, ask some questions, post some charts. Even if you're completely lost, jump in the Discord and have a conversation, and we'll get you there. So yeah, God bless, guys. Let's go make some money.